Hello, I'm Peter Towers, Managing Director and Founder of ESS BizTools. Welcome to the ESS BizTools Accountants Minute podcast. Profits begin with the right price is the title of this discussion today. One of the fastest ways to boost performance by SMEs is not necessarily found in slashing expenses. It's in getting the price right from the start. Yet many businesses are charging rates that fall well short of covering not only their overheads, but generating a profit for the business. As their trusted advisor, as an accountant or a bookkeeper or business advisor, you should be able to give them advice because you understand figures and understand what effect that charge out rate has got in determining how the business is going to perform. So accurate charge out rates are more than just figures on an invoice. They're a statement of the business's worth, and it's very important. Undercharge and your clients chipping away at their margins. They might even be trading at a loss. Overcharge without justification because your client's got an outstanding product or service and they risk losing valuable customers. The challenge is finding the sweet spot. I try to do that with my golf club when I hit a ball, but that doesn't always work, I know. And the same challenge confronts us in business, doesn't it? Confronts us as accountants in our own businesses, and we're trying to give advice to our clients. But this is the very important advisory services that our clients need. They need to understand what their operating costs are. I think it all starts with understanding, first of all, the key employee costs, the labour on costs. You know, over the years, I've sat down with many SMEs and those in charging time, whether they're accountants, lawyers, some sort of tradie industry, did a lot in the steel fabrication industry, and asked them how they determined their charge out rates. Oh, well, it's what the industry association told us, or it's what I heard a competitor was charging, or what the biggest business like ours in our area, we find out what they're charging and charge it. That's got nothing to do with your clients' overhead expenses or their productivity of their team members. All this needs to be calculated on their activities. So the tools that we've developed at ESS BizTools that are available for our members remove the guesswork from pricing, because we start off with the labour on cost to start with. The annual leave, the penalties, the superannuation rates being actually paid, the study leave or the training leave for apprentices and others, the professional development time. So out of the total number of hours being paid in the year, what is available to earn income for your client? And then what's the percentage of that time that's realistically going to be charged to a client? It's no use doing this exercise to determine a charge out rate and then having the client or someone in their office ignore all of the hours. So we need to make sure that the productivity percentage is realistic. When I was a young accountant, I come across a client that tried to tell me that 100% of his time was going to be charged out. And I had an argument with him and he left our firm. A few years later, he rang me up and said, "You were right, you know." I said, "Because I was right. We weren't going to get 100% charge out." So the other key expenses, we've got the labour on costs. Obviously, we've got the amount of pay that's been paid to the annual cost of these people in their wages. We then need to look at the overhead costs. What are they to run the business? We need to look at the targeted profit margin or the rate of return on the investment that they want to achieve, whichever is the figure. Are they happy with a $100,000 profit, or do they want a 20% return on the investment in the business? What's the investment? And if the investment was $800,000, well, obviously they're then targeting $160,000 as the pre-tax profit. And there's always a question about what they're doing with external purchases they make on behalf of a client. A lot of tradies do this. They say, well, we'll get the carpet and we'll lay it, or we'll get various timber components or paint or light fittings. And that's costing your client time and their credit facilities, because normally they have it charged to their account. They're responsible to pay the merchant or the hardware store, or whoever they're buying it from. And then they've got to recover that from the client. So what percentage markup do they put onto that? Is it 10%? Is it 20%? Is it ad hoc? Well, we're trying to do a budget here, so we need to get the client to specify what that will be, and then what they're going to do. So if they're spending $1 million on external purchases and they're going to mark them up by 10%, that's an extra $100,000. What are they going to do with that $100,000? Do they want to retain it as a super profit, or do they want to use it totally to subsidise the labour costs, or do they only want to use, say, 50%? Our system allows you to make that decision. Any percentage you can nominate, and the system will then put that nominated percentage as a credit in the calculation of the recovery that has to be made for the labour or from labour, and the remainder will be basically a super profit that's included in the profit and loss account. So this will give us realistic charge-out rates, no guesswork, no gut feeling, but instead looking at it very closely. And then it should be monitored, because there's some key ingredients in this. It's the number of hours that's going to be worked for the week by the individual people, what their productivity percentage actually was as compared to the budget. And if you find that the calculations were done on a productivity for a certain trade level at 80%, and for a number of reasons they're only achieving 72%, I think it's very worthwhile to say to the client, well, we should recalculate the charge-out rates based on the information we now have, because that will affect the charge-out rate for the remainder of the year. It's too late for anything they've already quoted, of course, and the work they've done. But the whole objective should be, in trying to implement this profits begin with the right price, is to look at getting these percentages right and correcting them if we find that they're not correct. Now, this strategy also works for tradies, it works for professional service firms. So there's a lot of businesses. I would estimate at least 500 different categories. So surely you've got them within your clients. Now, the edge you have in all this is being able to do the calculations, talk to your client, get it set, get it implemented within the system. These are the charge-out rates to be used for those various employee categories or individual employees, if it's varying that much. And then to monitor their performance. Each week, the key monitoring would be around the productive hours that have been achieved by the various categories. And it's not just the total productive hours, of course, because if they were all achieved by apprentices, they're probably not getting charged out at the rates for a leading hand type person. And there still won't be enough revenue created if you're just looking at the total number of hours that they're inflated by a period where there was no training for apprentices. They were there and they were working constantly, and but their charge-out rate will probably not be enough to generate the amount of revenue that's needed. And this will make your client more familiar and more objective in what they're looking at in their reports, so that the weekly performance report should be able to be calculated and show them what their profitability for the week was, because they will know what they're charging their labour out at. They know their actual labour costs. The quantity of materials they're purchasing for clients for that week can be calculated. If they've got a standard markup rate, say 10%, they know what they've earned there. Then they know how they're treating that. If it's all going as a subsidy in the charge out rates, well, they don't bring it in as income. But if they're keeping it all or keeping 60% of it or whatever, they can bring that in to their calculations. So this is how you shift from being a compliance provider to becoming a strategic partner with your clients and their success. You become the internal accountant working for them. And if you were working as an internal accountant or chief financial officer, you would be undertaking this type of work. I did that for 12 years of my career, and I can assure you that the CEO continually had questions, or if not, so did the other members of the leadership team. I was a member of the leadership team in our company. There were 12 of us in the leadership team, but I think I got more questions than anyone else got, because they were always looking at angles. Could we change this? Could we change that? What's the effect going to be? So we had a key costing role to play. And I don't hear people talking about costings anymore. And I think that's part of the problem that small businesses have got, because the big end of town still talks about costings. It's very important to make sure that the costs are all being fully allocated to what they related to. So what else are we going to look at if we're going to perform this role? So your role as the trusted advisor to SMEs is to translate the reports into action by combining accurate pricing models with regular performance tracking. That's it in a nutshell, I think. That's what we're there to do as an industry supplier. So we have a special webinar that we're presenting on the 28th of August, 11 a.m. start, AEST, which is looking at Know Your SME's Worth charge out rates that work, so that we can take you through the steps. I'll show you the labour on cost calculator we've developed and the spreadsheets that we've developed. It works quite simply, and it will give you working charge out rates that can be applied. But like everything, it needs monitoring. It's not a matter of preparing it and throwing it in the bottom drawer and reappraising at the end of the year. That's not good accounting. And that's definitely not how the big end of town work. They want to know continually what was the result. And we should be doing that weekly, monthly. Not just leaving the poor old client who's relying on our charge out rates to be able to look at this at the end of the year. So the purpose-built calculators will help you. Now, I tended to talk about tradies and professionals in my comments, I've realised. But also, we have a similar package to help retailers and wholesalers. Now, they've got a different situation, haven't they? In a retail business, there's not many of their staff being charged out like a tradie or a professional's charged out. They may have someone. If so, they can use the charge out calculator for that. You'll have to modify it a bit to do that. And if you have some problems with that, you can contact me and we'll implement it into our system. But the main problem with retailers is that they've got a various range of products. And those products are all got different characteristics relating to the volume that you think that the client is going to purchase, or the client thinks they're going to purchase of that category, and what the markup that they can charge in their marketplace for that particular product. So they may have 20 main department lines. In some stores, of course, there's a lot more than that, but 20 major characteristics that they can look at. And they're going to have some stars. Now, stars are high volume and high markups. That's what they really dream of having. But unfortunately, it doesn't really work out that way. Everyone has cash cows, is a general terminology that FMRC, the Financial Management Research people under Andrew Geddes, called them many years ago, and that description stuck with me, the cash cows. They're high volume but low markup. You need them in your store. If you don't have them, you mightn't get the customers coming in. That's things like bread and milk in corner stores. And the art of selling in those corner stores, as I understand from experts, is not to leave those cash cows at the front counter next to the cash register, which unfortunately I've noticed a lot of small retailers do, but to place them, nearly hide them around the store, and alongside them put a star item, a high volume but a high markup, so that your customers of your kind have got to go for a bit of a walk through the store to find their newspaper or to find their bread or find the milk, which invariably are high volume but low markups. So your client needs to understand how all this works. And I've always assumed most people do, but over the years I found that a lot of people don't. They like the idea of buying a store. And I even had a situation where the guy had been the managing director of a listed public company who got the markups all wrong. He knew there was a thing called gross profit percentage, and he knew there was a thing called the markup, but he used the wrong ones. He used the gross profit percentage that he had embedded in his head as being the markup percentage, and he wondered why he wasn't getting the right results. He was very quickly going to go out the back door and go broke. He had enough brains, though, to ring for help because he'd been the managing director of a company. And he told me I had accountants doing all this. I never really bought into how they did the calculations. And we were a successful company. And they supplied the information. So when he was running his own business away from that accounting input, he floundered. And if anything highlights the reason why we're advocating that our SME clients need a strong accounting input, it's always that particular example. That gentleman had been managing director of a listed public company for quite a number of years. And he mixed up basic accounting information and changed his prices. I said, you must have the cheapest products in this market. He said, well, I wanted to make a hit. I said, you want to make a hit as big as what you've done? And I said to a couple of his staff who I knew, why don't you say something to him? Oh, he knows everything. He's the ex-CEO of a managing director of a public company. So I had to have a heart-to-heart with that gentleman and say, now, you've upset your staff. You've obviously told them you do know everything, and you've now been proven you don't know everything. I think you need to think about that in your dealings with them, because they backed off. You had a go at one of them for suggesting that you were not making the right decision. So the rest of them just backed off. They didn't say anything. They knew that you were charging too low a price, but you'd been the managing director of a public company. I think we all should dwell on what I've just said because it's very important. The man I'm referring to is passed on, and I'm not saying any more that as to who he was, but it's I think very important for us all to realise, because at times we talk down to our team who might see something obvious, but if they get snarled at or ignored, well, they give up saying this. Oh, well, leave it to him to sort out. In that particular instance, we were very lucky that my client was smart enough very quickly to get on the phone and say, something's wrong, can you come over here and have a look, because I'm just watching the bank balance and it's going down. So the monitoring of the information you get is very important, and communicate that to your client. And there needs to be an expectation in the client's mind and your mind as to what the results should be. We're not doing any of this with our eyes shut. They should be wide open. And I think it's a great idea to build in the expected result. In other words, a budget. What's it saying we should make this week? And if our calculations that have been already prepared say we should achieve 38% gross profit percentage overall on the mix that we think the retailer is going to sell. Now, that is guessing, but still and all based on previous sales. So many of this category, so many of that, and there's different markups. Overall, it should be 38%. If it comes in at 22%, alarm bells should be ringing. What happened? Did they buy all the cash cows this week? Did everyone else around the area run out of cash cows? Or everyone come to your client store and bought all that produce? That's not likely, to be honest. So what went wrong? And invariably you'll find that was a mathematical error somewhere, or the stock take wasn't done at the end of the week, or it wasn't done properly, or the special product that was factored into that overall result didn't turn up and got caught up in a transport difficulty. It might have been a flood and the trucks couldn't get through, so you never had that great product. Well, the expectation should have been changed. If, because you didn't have that product, the result was only going to be, say, 27%, well, that's a bit closer to 22%, and it could have then been further analysed. I think this is the key role that, as accountants, we have to play to help our SME clients navigate the difficulties of running businesses. Because if you were working in a larger corporation, that's part of the role. Now, it mightn't be you exactly, but there'd be other accountants or members of the accounting departments who would be doing these costing exercises. And if you were the accountant, you would be responsible for it, to sit down and analyse and look at their calculations and probably sign off on it because you're the boss and it's going through to the other members of the leadership team. And that's why big businesses do it. They want to know that if they put that product range out in this week, this is what the result should be. Now, it doesn't always work out, but it's when it doesn't work out, that's when it needs to be investigated there and then. So what happens in your SME clients? I want to just stop here for a little while and just say to you, what happens in your SME clients? Do any of them have the time and the ability and the willingness to undertake the evaluation that I've just referred to? Do any of them already contract your firm to go in and monitor it, or do they have someone else that monitors what happens in the week? I think I'm hearing a rather deafening no to those questions. It doesn't happen. But in larger businesses, it does happen. In Australia, we've got over half of the 2 million SMEs in poor business conditions, according to the Australian government-funded Small Business Ombudsman. Now, they're an independent organisation, but they're funded by the federal government, which is great. They do a lot of good work. Their report at the end of March indicated that half of the 2.2 million businesses were earning less than the average national wage. And some of them were trading at a loss. A lot of them were trading at a loss. If we were more enthusiastic and more promotional conscious to talk to clients and business people generally about these types of issues, I think we'd get take-up. Some accountants say to me, oh, the clients won't pay for it. I said, if you sat down and talked to them about this and given them an example and shown them how it would work, oh, no, they wouldn't listen. I said, well, put on a few bickies and a cup of tea, and if they survive for the hour, they can have a beer or a glass of wine. You'll get people coming along. But you need to get the message across. because that's the role. Do you really think the tax return helps your clients run a successful business and make money? Or do they just survive? We need them in thrive mode. We need them to be enthusiastic about what's happening. They've got enough challenges as it is. Some of them have got union problems. We've got governments that I don't know really what the government's policy is with small business. But I get a bit suspicious at times what it might be. So what can we as a profession do? If you went to your medical practitioner and decided that everything you were supplying to them, you're only paying them because the government said you had to, and you were getting no benefit out of it to help you with your health, would you be happy? I somehow doubt it, but think about it. In some cases, small businesses get charged thousands of dollars primarily for an annual set of accounts, probably now these days for 4 BAS reports during the year, and a tax return. I don't think any of that's helping your clients run their business. They need to understand their key performance indicators, their business metrics. They need to understand the basis of how they're setting their selling prices, whether it's as a tradie, a professional service firm, a retail or a wholesaler. Because the whole aim should be to achieve their profit target that they've set. That's the challenge. Are we providing that type of service to help our clients not only survive, but thrive? And if the client really wants to scale up and go for it, are you able to help them do that and achieve that dream? Because you're able to supply the services to them. And most of them, when they start the scaling up process, do not need a full-time accountant or chief financial officer. But they need access to a great accountant or a chief financial officer to help them. So that's the challenge I'm going to leave with you at the end of this podcast today. Please think about it, how you can offer this range of services that will really help your clients run better businesses so that they ultimately can retire with dignity, having enjoyed their life of running a business. Stay safe. Have a great day. Goodbye.